Hi, I'm Brooke Thackeray. Welcome to What's Hot and What's Not in the month of April. Before we take a look at what to expect from a seasonal and technical basis for the markets and sectors of the market in the month of April, let's take a look and see what happened in March, because there were some interesting developments with certain sectors outperforming that typically don't outperform, and that could be sending a signal as well. Let's start by taking a look at the S&P 500 here. You can see here that the S&P 500 on the 1st of April did set an all-time high above 4,000, which is quite incredible. We're still in that upward trend channel here going back to October. We did break below that a little bit in mid-February and also at the beginning of February as well. But right now, we're still all-time highs. Who can complain? We have seen the relative strength index actually move lower, which is a divergence, which often indicates there's weakness ahead for the market when the S&P 500 is moving up and the RSI is moving down. That hasn't happened, and it's not a major signal. All-time highs, positive development. Overall, the technical picture for the S&P 500 is still favorable. We're still in a strong 6-month period for stocks as well. If we take a look at the major markets here, we can see here the S&P 500 in the month of March was up over 4%. The big news was the Dow Jones up 6.6%. So there was a shift taking place last month in the markets. Look at the Russell 2000, which has been outperforming the large caps for quite some time. In the month of March, actually turned down. Now, the Russell 2000 finishes its seasonal period in early March. And in fact, if you take a look at the IWM for the Russell 2000 here, and this is relative to the S&P 500 and just early March, once again, we did see the Russell 2000 start to underperform the S&P 500 here. And so a lot of those assets shifted back into the large cap stocks, but we'll also take a look at where they also shifted as well in a second. The S&P TSX Composite was up over 3%, 3.5% last month as well. Less than the S&P 500, but still positive. NASDAQ was barely positive, actually, in the month of March. Here's another big story, was the emerging markets. Now, emerging markets underperformed last month. One of the reasons was U.S. dollar is actually been improving in strength. I know a lot of Canadians follow what I do, and so they compare the U.S. dollar versus the Canadian dollar, and the Canadian dollar has been actually performing quite well. But guess what? Canadian dollar is actually one of the top performing currencies in the world. U.S. dollar has actually been strengthening relative to world currencies, which hurt the emerging market sector. If we look at different sectors of the market, here's the big surprise that took place. Look at the top performing major sector in the market last month. Utilities. Really? Utilities. Now, interest rates went up last month. So what's going on? And if you take a look, consumer staples doubled the performance of the S&P 500. What we saw in the month of March, one of the things we saw was investors shifting away from some of the risk-on mode that they've been on, and they still want to be invested. And so they've been shifting to some of the defensive asset classes, sectors such as staples and utilities. This is despite interest rates going up. Now, these sectors often outperform when interest rates are going down, and there's concern in the market at the same time. But interest rates actually went up in March, and these sectors outperformed. So we're seeing a signal here that, yes, the market's moving higher, but it's getting hollowed out underneath. Investors want to still be there, but they're starting to get a little bit concerned with the valuations of the market overall. We did see last month the industrials and materials perform quite well. Look at technology here. Technology didn't perform well at all last month. And that's one of the reasons why, is because of rising interest rates. And if we take a look at the technology sector here, you can see here that relative to the S&P 500, we saw this let's draw that box here. So we saw this box consolidation taking place here, really from August into March, and then we saw that break below in March, and we've now started to form another consolidation box as well relative to the S&P 500. The technology sector has really been lagging. It'll be interesting to see if it can break above here, get back into this box right here that we saw earlier on as well. So if we can get back into this box here relative to the S&P 500. No guarantees on that. The technology sector really hasn't been performing well relative to the market for quite a few months here. If we take a look at some of the other sectors of the market, discretionary sector outperformed the S&P 500 as well. Real estate actually performed quite well in the U.S. Financials, rising interest rates helped that sector as well. If we take a look at some of the smaller sectors in the market, we can see here that in this case, steel and materials, metals actually performed quite well. So the cyclical sectors did quite well, Home builders, typically home builders start to fade in February and March. They were up despite rising interest rates. So that's partly been the excitement around what's taking place with house prices moving up and home builders actually performing quite well. The transportation was positive. Retail. So March tends to be a strong month for retail, and this is, I know in some ETFs have GameStop in them more so than others, but overall we did see across a number of ETFs, retail performed quite well. Gold and silver were negative last month. They tend not to perform well in the month of March on a seasonal basis, and also biotech, same thing, negative, and also from a seasonal basis, it's not the stronger month of the year for the biotech sector. If we take a look at the VIX, if we take a look at 20 here, so a lot of people look at the 20 level for the VIX to represent the fear gauge in the marketplace. And let's go back over here. You can see here that we saw that we didn't see the VIX come back to the 20 level really till February. Mid-February, we saw it touch and then go back above. And look what happened in March. Went below, and then coming into April 1st, we saw that drop well below and down to 17.33 for the VIX. So what does this mean? It means that we're seeing a little bit more complacency in the market right now, less fear overall in the market as well as the S&P 500 has moved higher. And the other thing that's making a lot of news is the interest rate. So we're looking here at the 10-year yield. You can see here in the month of March, up, positive. Now, in the last part of the month, we did see that flattening out for the interest rates, but overall, we did see the 10-year yield move higher. Okay, look at this rise since last August. We've had some consolidation along the way, but overall, we've seen an incredible rise. Just to put that in perspective, look at this. I mean, this is once again the same yield on the 10-year here. You can see here how it's gone up here, and it's just been a huge rally. But I wanted to point out that interest rates from a seasonal point of view tend to start to roll over in March a little bit, but really they start to go down on a seasonal basis on average in May. And let's go back to 2015 here. And so here's April here. So really this is about May at this point here. Now, so in this case, interest rates continued to move higher really until towards the end of June before they started to actually roll over. And so with seasonals, you were looking at, on average, what happens. Sometimes it can start early and sometimes late. In this case, it started late. If we take a look at May here, here's April. So May's really around here. We did see that roll over. Interest rates went down, came back up into May, and then started to roll back down again. And in 2017 here, you can see here that it was really in May, once again, we start to see this underperformance for the interest rates. 2018, if we take a look at May here, we saw a little bit of a top here for the interest rates. Then it really formed this box going back and forth. And don't forget, 2018, that was when Powell started to talk about raising rates, getting back to normal or neutral or whatever it was that he kept on talking about. So we didn't see the interest rates fall from here, but we did see that peaks happen once again in May. And 2019, we did see this as Powell promised never to raise rates again. Well, he didn't say that at the time, but I'm being facetious. But he did make some promises to be more dovish, and the interest rates started to fall here. But even if you take a look at this scenario, here's May. So we saw a little bit of a run up in April, and then we saw that turn down. The interest rates turned down from here. It's 2020 is 2020. We saw interest rates plummet in February and March, obviously, as well. So what I'm trying to say with the interest rates is that interest rates have been moving up. There's been a lot of talk about it. They can still move up higher from here. But typically, in the next month or so, we might actually start to see them soften up here a little bit. We're starting to see some softening of interest rates, but we could actually start to see them turn down. Something to watch out for. I'll talk about that in the future as well. Let's take a look at earnings expectations. April is an earnings month, so Q1 earnings month. And if we take a look here for 2021, you can see here for the earnings for the S&P 500, 24% growth. Now, you obviously have to take a look and go back to Q1 here in 2020, and so because that's your comparable base. Now, you can't just visually go, oh, this went down by 13%. And here's 24%. Now that's still a huge increase, of course, and that more than offsets that. But what I'm trying to say is that a 13% drop, once you get to that base, and then you go up by 13%, doesn't take you back to the original level. That's the laws of mathematics, of course. But overall, these are fairly big expectations on a go-forward basis. And even into 2022, the earnings expectations are actually quite strong for the overall market. So if we take a look at what could happen in the stock market from a seasonal basis in April, let's take a look how the stock market's done in the month of April. Here I'm going to use the Thackeray's 2021 Investor's Guide. And if you take a look here, we're going to take a look at the average month of April for the S&P 500 from 1950 to 2020 here. Every month's different, of course, but on average, the first 2/3 of April tend to be quite strong for the month of April. And it's the last third of the month that tends to be, well, relatively flat. And if we take a look at this graph down below, this is the frequency of performance on a trading day basis of how often the S&P 500 is positive. And you can see here that in the first 2/3 of the month, you can see here that this is actually quite strong. We're getting values of over 60%, which is actually quite strong. Now, it doesn't mean that every day is going to be that way, but on average, over the long term from 1950, you find the first 2/3 of the months, you tend to find more positive days in the first 2/3 of the month. And the last third tends to get back to normal here, and we tend to see a flattish performance for the S&P 500 as well. So what's happening here? A possible explanation is April is an earnings month. And you find in the earnings months that the first 2/3 of the month tend to be quite positive for the S&P 500, the overall stock market as well. As investors expect their earnings to come out and try to front run the earnings and get into stocks ahead of time, which tends to push up the overall markets as well. If we take a look at the sectors of the market, we can see here that the energy sector tends to be quite strong. It's one of the top months for the energy sector. And this column represents the performance of the sector relative to the S&P 500, the frequency of outperformance. Here you can see that the energy sector has outperformed since 1990, 65% of the time. And now, if we take a look at what's happening with the energy sector, and this is important here because get the energy sector up here. This is I'm using the ETF in the US, XLE, and if we take a look on an absolute basis, we saw the energy sector peak in early March, and really relative to the S&P 500, you saw the energy sector actually peak at the end, once again, early March again, a little bit ahead of its absolute nominal performance peak, but we saw this underperformance taking place. Now, we started to see that run relative to the market in early February. Now, it's important to realize that from a long-term perspective, the average seasonal period for the energy sector starts on February 25th, so late February. That didn't happen this year. It started early this year. So we had this consolidation box. Let me just draw this box here a little bit. So we saw this consolidation box relative to the S&P 500 taking place. And then from there, we saw this outperformance start in late beginning of February and into March as well. In fact, what we've seen recently is this break of that trend as it's gone down. So the reason I want to highlight that is that it's possible that we could have seen the energy sector start to outperform the stock market earlier than normal this year, which could present the scenario that could be finishing up its seasonal trend earlier than normal as well. It doesn't mean it is. The energy sector can continue to outperform. But given the fact that we started early, there could be a scenario with a higher probability now, because we started early, that the energy sector is actually starting to taper off here as well. It's something to watch out for sure. If we take a look at, the other sectors of the market here, the material sector tends to be a stronger performer. Consumer discretionary tends to be one of the top performers. The financial sector as well. Financial sectors actually perform quite well. If you take a look here, for the financial sector, let's go back over here for the financial sector and take a look using XLF in the States, and this is relative to the market. Now, look what's happened here. Let me just draw a line here. You can see here that we've seen this as interest rates were increasing, the financial sector outperformed. But as they've been moderating a little bit, even before they started to turn down a little bit, we've seen the financial sector start to underperform. It's possible that we could have just seen such a strong run in the financial sector. Now, the word of warning for the financial sector is, yes, it is. if we go back to this diagram here, or this table here, the financial sector is one of the better performing sectors in the month of April. It tends to perform quite well in the first half of the month, and then tends to pull back in the second half of the month. Something to watch out for. Industrials also tends to be one of the better performing sectors. If you take a look here, consumer staples. Now, it tends to be one of the weaker sectors. Utilities at the bottom here, healthcare, telecom. Now, I just showed you a chart showing you that some of the top performing sectors were consumer staples, utilities as well. So some of the defensive sectors. Now, the consumer staples sector starts its seasonal period usually on April the 23rd. So once again, about 2/3, a little bit longer than 2/3 of the way through April. It's possible we could have started to see the shift into the consumer staples sector and the utility sector earlier than normal because investors have been shifting some of their assets. So yes, they are on the bottom of this ranking here over the longer term, but their seasonal periods do start around this time period or coming up shortly for the consumer staples sector. And so it's possible we're starting to see that shift happen as well. If we take a look at some of the sectors of the market here, you can see here that automotive tends to perform well. Now, it's interesting because it only outperforms the S&P 500 52% of the time since 1990, but it's got this huge return. So when it outperforms, it really outperforms, and when it doesn't, it doesn't. So it tends to be a more volatile sector in the month of April. The railroad sector tends to perform well. The semiconductor sector tends to perform well at the same time. Chemicals actually has a high rate of outperformance in the month of April as well, but it can start to fade off fairly fast towards the end of the month, so it's something to watch out for as well. If we look at the bottom here, I just want to go down to the bottom. We've got gold, silver, biotech. Those sectors did all negative last month in the month of March. Sorry if I said the month of March earlier. Actually, I meant April here. But all three of these sectors, gold, silver, and biotech, outperform or underperformed the S&P 500 and were negative last month. They tend to be weak at this time of the year. So obviously, things could change as well, but especially since they've been underperforming here. But right now, from a seasonal basis, it's not something that you would expect for the sectors to outperform. In summary, we did see the S&P 500 perform well in March, but we did see that interesting phenomenon with some of the defensive sectors starting to outperform the S&P 500. And this could possibly be a shift earlier, because typically you don't see the defensive sector start to outperform until a little bit later on. But it's possible we've started to see a shift from some of the other sectors in the market into the defensive sectors as investors have become concerned with valuations. They still want to be invested in the marketplace, but then they shift into some of the defensive sectors, which have been performing well despite rising interest rates as well. Now, if interest rates go down, that would also potentially give some of the defensive sectors a boost as well. We still are in the strong 6-month seasonal period for the stock market. April tends to be a strong month as well, but the gains tend to come in the first 2/3 of the market as we head into the earnings season. And this year, from an earnings perspective, it's the U.S. banks that start to report on the 3rd week of April. They tend to be the unofficial leaders for the earnings season as well. So it's going to be interesting to see how the stock market reacts to the bank's earnings at that time. Well, thank you very much for joining me today.